Welcome to IG's Trading the Markets podcast. I'm Jeremy Naylor. Today we're looking at one of the big market correlations that traders often follow, and that is the relationship between the price of gold and the US dollar. Let's introduce our guest on the podcast today, Daily FX currency strategist Michael Boutros. Michael, it's good to have you on the pod.
Welcome.
Great to be
with you.
Look, before we draw you in on this gold-dollar trade, I think it would be right to look at your trading strategy and methodology. How do you set up trades and what do you look at when planning your positions?
Absolutely. So my strategy is completely based on what market price action is doing. Price action is what we're trading, price action is what we're studying, and price action at the end of the day is what's going to determine everything. So my trade setups will be completely based on where we are in trend, how close we are to the extremes, finding major pivot points in price. I'm a big user of slope analysis, so a little bit more in-depth than basic trend lines using pitchforks. But at the end of the day, what we're trying to identify are key reaction levels in price. Now, you can't dismiss the fundamentals. So fundamentals do fall into it in helping us get a broader roadmap. I always liken it to taking a trip from New York to LA. The fundamentals are kind of going to be the broader picture. You're heading west, right? That's kind of like the direction that you're heading in. You have to have a larger bias. The breakdown of the highways and the streets that you get use there, that's where the technicals come in. So while I can have a larger bias on something based on a fundamental outlook on the macro picture, there will be times where the trade setup will be, counter that, and we'll take counter trend trades to take advantage of price movements. So real discipline to studying what price is saying more so than anything. And these economic developments, these announcements, these reports, these oftentimes are the catalyst that actually will trigger the trade or put the trade into play. So a little bit of mix of both, but very heavily on the text.
Absolutely. Okay, well, we'll take your view on that in just a minute. Before we get to that, I know you're a seasoned trader. I think that's fair to say that. You've been through the learning process. To what degree do you still think about trading psychology, or do you just have a set of rules now that you've hammered out that you like, that you follow, and you just stick to them? Or do you think to yourself, the trading psychology here is trying to get the better of me, I must bring myself back into rein, if you like?
Absolutely. I mean, you always say that you're your worst enemy in trading, right? So psychology has a lot to do with it. Now, I try to stay based on what the price action is saying, but obviously looking at the market psychology is huge. So oftentimes we'll see on Daily FX the IG sentiment index, which is taking a gauge of what retail positioning is doing. You have the COT data report, which again gives you kind of a gauge. But broadly speaking, the sentiment, when it reaches extremes, or when you see that net trade or net retail traders are moving to either net positive or negative, it's those switches and moves in sentiment that matters. A lot of people will tend to stress, well, there's a lot of long interest. That's true, but that long interest could last for days, months, weeks, right? It's the shift that you see in that interest that really tends to bring my attention in more. So the variability in it is something you want to pay attention to. And obviously the old adage, cautiously with, boldly against, when you find major technical levels where there is exhaustion both in price and sentiment. You see a lot of interest on those trades will typically be really good turning points in price. And also non-confirmation lows and highs. So a lot of times related assets, one will post a new high while one will not. When you see sentiment reaching an extreme on either of those assets, a lot of times that'll be sort of an indication or highlight the threat of a larger market reversal. So sentiment definitely comes into it for sure.
Okay, let's then look at the fundamentals. Now, you say you don't go deep into these, but you touch upon them. What are the fundamentals you're looking at the moment? You're talking here about two particular trades, gold and the FX markets, which are quite closely linked to what's happening in the fundamentals. From a big picture point of view, what do you regard as the major fundamental news that you think we should be looking at in order to start us out on this idea for a trade?
So the fundamental idea that everyone's going to be focused on will also obviously be the Fed outlook. This has been something that has kind of been driving markets. My opinion on it is something different, but driving markets, whether it's justifiably or not, for the last couple of years. Look, the big picture is there's no outlook here that is necessarily going to be supported from the dollar from a Fed standpoint, right? We're looking at unemployment essentially at the natural rate, 3.5. The biggest issue that we're seeing is inflation. That's really what's holding the Fed back. And even that's starting to soften. Average hourly earnings were like 2.9% year on year on the last clip, I think, down from 3.1. So if you look at Fed fund futures, heading into the close of 2020, they're looking at the possibility of another 25 basis point cut, right? So to look at the Fed outlook, there's going to be no rush for them to hike on rates. It's an election year. Obviously, that's going to be a variable play as well. So looking for dollar support, there's two scenarios that you want to pay attention to that could stoke sort of a dollar move. And then we'll look at what the technicals are saying. One of those scenarios, obviously, is that something turns negative in the overall development of the China trade deals. If negotiations fall through, there's a default in the plans that's moving forward. That might be an interruption that would stoke a larger market correction and could give support to the dollar. The other issue is some sort of play as far as just a downturn in equity assets, which have been, on a tear. There's nothing to suggest that that's on the horizon, but that's another stoke for the haven flow that could help the dollar. Barring those two scenarios on the horizon, the dollar has come off pretty big resistance last year. And heading into August, we were looking for a more prominent reaction, didn't get it. Headed September, October struck the level, same regions of resistance held before a massive reversal. That pullback starts the year just above uptrend support. So you're basically looking for a key range break in the dollar here. And based on what happens in the first quarter, obviously the opening range for the year can be very telling. The most important thing to keep in mind is that despite a 3.7% rally last year, the dollar only closed the year up fractionally, less than 0.5%.
How do you get your exposure to the dollar? Are you talking here about the dollar basket, that is the dollar against a basket of currencies, or are you taking it against the euro or sterling? What's your best bite on the dollar at the moment?
Correct. So the dollar levels I'm talking to you now are about the DXY, dollar index on the ICE. You can trade that through. There are a couple of beautiful setups, i.e. the euro is going to be most heavily weighted that index. So if you just take a look at euro dollar, that made a very key reversal in September, also off of downtrend support. That's testing downtrend resistance into the open of the year. So it's the inverse of the DXY trade, which again suggests that you should be looking for some sort of major breakout in the first quarter on both of these assets. For the euro, anything northbound of 109.76, which is last year's low week close, is still putting this thing on a constructive path. So when you take this into account with what's going on with the geopolitical environment, with the Fed, it kind of leaves room to, if the dollar continues to get a little bit more upswing. I mean, since the start of the year, the dollar has been more or less on a firm footing. It's stronger against most of its major counterparts, mostly the commodity currencies, which is also a good scenario to look at. But does that dollar correction higher early in the year find exhaustion? That's kind of the focus that I'm looking at with the broader picture.
One of the big things, of course, is recently has been this trade. If we can switch into the gold trade, one of the big things, of course, has been the risk-off trade, the really big risk-off trade. From a fundamental point of view, of course, we had the activity in the US, in Iran recently, which has seen that real spike higher for gold. But I know that we, as traders, should be aware of the correlations around gold, and that is looking at the dollar's relationship with gold. Is it just a dollar relationship with gold because gold is priced in dollars, or are there some other foreign exchange crosses and currencies at play here which you can play against gold?
Sure. Well, the dollar being based or the gold being based in dollars is a contributing factor, but that's just the tip of the iceberg. The true risk off flow will actually tend to help both. When you see really strong times in market risk off, markets will turn on higher yielding assets. They'll jump into the dollar, jump into gold, they'll jump into yen. And these will tend to do well. As far as the rip that we saw higher in gold, I don't really attribute that necessarily to the risk off trade per se. because you didn't see markets turn over extremely heavy. You didn't see the dollar necessarily give you the same type of move that you would expect to see in a true risk-off environment. So I don't really necessarily buy that we're in a risk-off environment on whole right now. But the correlation that you see with the dollar and gold, that has actually started to pull off. A stronger correlation I would suggest to your listeners is actually dollar yen versus gold. If you look at the historical correlation coefficient between those, it tends to be actually a little bit stronger. Both of those correlations have continued to pull back. I'm talking about like a yearly 52-week study. Now, if you take a little bit closer of a view, Jeremy, and you kind of zoom in into maybe a 3-month, 12-week type of study, that would suggest that the correlation has all but broken down. The dollar yen correlation, for example, with gold right now is pretty much at null. If we look at the DXY correlation, that's still negative, but continuing also to tailor off. So while the correlations can be helpful for longer term trends, for the average trader who's a little bit more active, it's going to be something that can really lead you astray. I would always highlight and tell my guys to kind of focus more so on what the technicals of each of these are saying separately. But if you're going to be looking at corollary plays, I would probably be a little bit more leaning towards the dollar yen gold correlation, just as a better gauge. Of what's going on with the broader picture.
Just finally, having discussed around this subject of the correlations, just to talk about gold specifically to wrap us up here.
Yeah.
We saw that spike higher, as I said, and we're touching that 1600 area very briefly around the heat of the moment between the US and Iran. We've since seen a pullback, and as we go to air at the moment, we're 15.55 per ounce for a price of gold. What is your best case from where we go here, technically, stripping out all of the other aspects of trading? What about the price action on gold? What's your best case?
So I'll give you those levels in just a sec. One last touch I want to talk about as far as the dollar yen correlation. The corollary move that we're seeing, just on a study that I did recently, likens the dollar yen gold move to what we saw into April and March of last year. Now, recall, gold started the year, started to move higher, found some resistance, 1360s, that held for a decent pullback before the inevitable break later in the year. I'm thinking down the same lines because of where we are in price. Now, if we take a look at the gold chart in general, I published the quarterly and yearly forecasts on gold on Daily FX. So if you guys want to see this chart in live, the major level that we were talking about all last year was 1586. We ran through that, registered a high just above 16, and we closed well below. The risk into this year is looking for a larger pullback to get back in on the long side. The broader picture remains constructive for gold, in my opinion, just based on the technical standpoint. From anything basically northbound of like 1440s, you're still constructive. But to start the year, you're going to want to see a more material pullback before you start loading into the longs. At the end of the day, if we get a breach on a closed basis above 1586, you're looking for continuation. I think we get resumption, well into the 17s. But before we get that resumptive play based on the stretch we got late last year into the start of this year and that level reversal we made off of a key technical level, I think you want to wait for a deeper pullback here to get back in the long trade. So for guys who are looking near term, I think the risk is for rallies to be faded. Medium term traders, longer term guys, you want to use that larger pullback early in the year to find some sort of basing to get back on the long side. I think this has still got some legs behind it. We made a pretty big move. Just need some exhaustion before we get back in.
A good old technical term. Michael, look, we've got to leave it there, but thank you so much indeed for joining us.
My pleasure. My pleasure.
You can catch up with Michael's thoughts on the Daily FX website, www.dailyfx.com, and follow Michael Boutros on Twitter @MBForex.